Hi, I'm Paul Carroll. I'm the editor-in-chief at Insurance Thought Leadership. I'm delighted to be joined today by one of the rock stars of the industry, Ken Mungan, the chairman of Milliman. We're following up in a series of these interviews after the Global Insurance Forum put on by the International Insurance Society a little earlier, where Ken was moderating and leading a panel. Today we'll talk really about the protection gap, but it'll go much beyond that. We'll talk about climate change and how climate change feeds into the protection gap, and then get into some really intriguing ideas that Ken was laying out for me the other day about how to reinvent insurance. So Ken, first of all, welcome. Thanks for doing this.
Thank you very much, Paul. I'm delighted to be here.
So on the protection gap, could you just sort of start out by letting us know where we are at the moment and in rough terms, where maybe we can go from here in terms of narrowing the protection gap?
I'll be glad to. So the protection gap is an insurance industry term. It's been around for decades. It's basically that gap between the risks that people, families, communities actually have, and then the risks that they've actually insured to get protection. There's a large gap. It's been kind of a societal problem, if you will, for a long time. And in the industry, we talk about it. We endlessly look for ways to address it, to narrow it. But changing human behavior on a society level scale, as you can well imagine, is incredibly difficult to do. I've been working in the industry now, for over 30 years, and I'm more optimistic now than I ever have been that things are truly changing in terms of moving people to a place where they have a higher level of protection, much better level of security. So it kind of starts in an unlikely place, which is COVID. You know, COVID was this absolutely horrible event for societies all around the world. But it really shook things up. It shook up the healthcare system. It forced people to engage with doctors and hospitals in new ways through telemedicine, through new technology-driven tools. It also highlighted for people the level of uncertainty that we have to manage in our lives, and that made people more susceptible to actually managing the risks that they face. Not only do we live in an age of uncertainty today with respect to pandemics, but everybody's seen the horrible situation in Ukraine that's leading to a global food crisis. We're seeing events related to climate change, and it's now affecting people's lives in very real ways. Just think of what's happened in Florida recently with Hurricane Ian. So people understand the level of risk that they have, and they're willing to actually take action to address it. Things that are happening, though, that I think are really going to make some changes, and I can elaborate on these any way that you like, is that now the technology is changing to drive frictional costs out of the system, so that people see more value coming from the risk management products that they get from the insurance industry. The business model itself is changing as platform business models kind of make their way into the insurance industry, and the organizations. If you went back decades, think of insurance companies as these very slow-moving, very conservative organizations. They become much more creative, which I believe is due to the fact that they've really taken to heart this need to have purpose-driven organizational cultures. They see such a clear purpose in protecting people, and they've used that to motivate the thousands and thousands of people that work in these companies to rise to a higher level, to harness innovation and creativity to solve the problems that affect real people's lives. So that's sort of my overview of what's going on. I'd be happy to dive in.
I would love to dive in a little bit. The efficiency is one that I've certainly harped on for a long time. People talk about the protection gap, but insurers are sort of in the business of charging people $1 and giving them back 60 cents. I mean, that's a harsh way of putting it, because there's a lot else that goes on. But if you can become more efficient so that you give them back 65 cents or 70 cents or whatever, then all these other things about peace of mind and protection and so forth are easier for people to stomach maybe than would be the case if you were just continuing to give them the 60 cents back. The one I'd really like to have you dive into, if you would, is this idea of platform businesses. That's a new and I think really interesting model, and I'd love to get your thoughts on that.
Sure. And the two are actually intricately connected. So if you think of efficiency, that's really about, given a way that we produce a product, is there some way, people often focus on it as, is there some way to incrementally reduce the cost of actually producing a product? But when you move to a platform-based business model, it allows you to provide people with risk management tools, insurance to protect against the risks that they face in a fundamentally more efficient way, not by making a small incremental change to the existing way that we do business, but by changing the way we do business itself. And ultimately, when you look at platform business models as they're coming to insurance, people tend to focus on the glossy, colorful things. It's, oh, here's a new app with a fancy website or an interesting user interface on the cell phone screen. But really, what's happening is you're connecting customers who need protection with insurance companies who are providing protection in a creative new way. And it allows you to use things like data, analytics, artificial intelligence to help people understand the risks that they face and come up with strategies for protecting themselves, and then figuring out which products can actually most efficiently do that. But I think the real benefit in the insurance industry of platform-based business models is that they have the potential to solve the problem of trust. People are not going to buy insurance to protect against a risk if they don't have sort of several dimensions of trust. Trust that this product will actually work. If the risk event manifests itself, whether it's a life insurance risk, catastrophic healthcare risk, long-term care, retirement security, whatever it is, if they don't trust that the insurance company is going to come through on the promise. And by having a platform where you don't just talk with, say, one agent about your particular problem, but you can actually see transparent data from thousands, millions of people like you who face very similar problems, and how they use the insurance tools to solve that problem, and that you could then follow a similar path. So I think that's really offers an amazing potential. In the Global Insurance Forum, the CEO of India First Life talked about the potential for insurance companies to share more data among themselves. In a platform, you take this even further and share widespread data with an individual seeking coverage, so that they can truly see, wow, people like me face this risk, and that has these dollar implications. And if I use this tool, I can follow this kind of well-established path to protect myself and my family. I think that's going to be incredibly powerful. Like the insurance industry in the developed world, the last few decades is really focused on the higher income segment, providing them with risk protection, but also providing them with kind of a bundled package that included things like tax planning, estate planning. And as the technology's now gotten so good, it really gives them a way to address the needs of all the other segments in the market, particularly that large middle income segment, so that they can show they can truly protect them with products that offer clear value.
I tell people probably too often that I feel like I've been watching the same movie for 35 years, going back to when I started covering the computer industry for the Wall Street Journal in the mid-1980s, and have very much seen the benefits of that sort of platform. If you look at the progress that happened through mainframes. IBM basically innovated when it wanted to, and you, the customer, could take advantage of that. But then when PCs came along and you sort of had an operating system that everything could plug into, then suddenly everybody was innovating at the same time, and the pace really picked up. The magic of the internet is that we went from having AT&T, again, control the central network, to having what people call a dumb network with smart devices on the outside. So every time you buy a faster computer, you make the internet a little better. Anytime somebody buys a server. So again, it's integration or innovation by massive numbers of people at scale, and things really pick up. So to turn to climate change, I mean, we've talked about how it ties into the protection gap because of the various risks in particular that are increasing because of climate change. You had a couple thoughts there that I wanted to explore. First is the idea of the tools that insurance companies are developing that are making them and thus everybody else smarter about how to anticipate some of these risks. And then we'll get to the investment piece. But could you talk a little bit first about the tools and the innovation that's going on there?
Sure. So first, I want to start with why the insurance companies really have to focus on this issue. As we saw in the Global Insurance Forum, every senior leader of the insurers who were speaking talked about the purpose of their organization, and they all had very inspiring, very concise statements of organizational purpose. Even at Milliman, I challenge all of our employees to say, what our mission statement is. It's to serve our clients, to protect the health and financial well-being of people everywhere. And on the Global Insurance Forum, the leaders were talking about helping clients live healthier lives with greater security, and kind of variations on that basic theme. And so if you think about climate change, if you accept that these companies have this purpose, that they're going to help people live healthier lives with greater security, then the insurer has to take climate change seriously and has to help its, typically millions of customers actually see that there's hope and a positive way forward to make it through this challenge. So in terms of the tools, the insurance industry has the most advanced, technology-driven risk management tools to evaluate the risk position with respect to climate change that I've seen. I mean, it's amazing when you look at how the industry has gathered the human capital, the expertise around things like, geographic information systems, the analytical systems to process all that data using AI, using actuarial techniques, to then go back and look at all the events related to climate change, and then to extrapolate them forward and say, okay, on the path that we're on now, here's the risk exposure that you have in a specific location, and so on, from the various kind of manifestations of climate change. The key thing is, now that they have that, what are they going to do with it? And as I look at this from the lens of the leadership teams, from the regulators, from the customers, you kind of get different answers. On the regulatory side, regulators are concerned that insurance companies are going to fulfill their obligations to the public. You wrote a policy, the claim comes due, is it going to get paid? And so the regulators have asked the industry, it's like, well, do some type of scenario analysis and look and see if we go down an adverse path with respect to climate change, and you have to pay increased claims due to whatever risk you're covering, will you be able to do so? So that's an interesting exercise. It's got a fairly significant layer of uncertainty around it. My view is that it actually misses the point. I think humanity is going to solve the problem of climate change. We're going to band together. We're going to take the systems that meet fundamental human needs around generating power, storing power, generating clean water, managing waste, transporting ourselves around the planet, and so on. And we're going to come up with sustainable ways of meeting these needs. And that a lot of these science and technology driven ways of meeting the needs have already been developed through the first few generations with venture capital. Now they've got to be scaled. The capital that's going to be needed to scale these technologies is going to be trillions of dollars, $1 to $2 trillion a year for the next 20 years. That's got to come from the insurance industry. Pensions and insurance are the number one and number two pools of global capital that will be needed to finance the response to climate change. So I know that's a long rambling thing, but back to the regulators, rather than saying to look at this from the perspective of a single company, if a bad thing happens to that company, really we need to look at it from the perspective of an industry, and is the industry investing in the way that it needs to as a group to address climate change. So one other thing, and then I'll turn it back to you. The industry, I mentioned the amazing risk analytical tools that the industry has. They use them to price the insurance that they have on the books right now. In the casualty area, that's typically an annual policy. There's an annual pricing cycle. A business, an organization, a family buys insurance for 1 year, you pay a premium, and then if the event happens during the year, you file a claim and you get paid. The key point is climate change is going to manifest itself over the next 20 to 30 years. And so year by year, from an insurance company's point of view, they can simply just keep raising prices year after year until they don't, until they say, well, this risk is now uninsurable. We're no longer able to provide insurance. And so society generally needs to recognize that the insurance industry has an amazing set of capabilities, but it's not necessarily using those capabilities over the 10, 20, 30-year period to address climate change. It's using those capabilities to keep the lights on and manage its business, year to year. And so there definitely needs to be more effective collaboration between governments, the insurance industry, the non-governmental organizations that are trying to analyze and come up with ways to address climate change. I think people are somewhat implicitly sort of looking to the insurance industry to do some things that it's not necessarily designed to do. So it's going to take a broader collaboration, if you will, to actually make use of the intellectual capital that's present in the industry.
On climate change, I try to wake people up sometimes by telling them that they may think they have a 30-year mortgage, but they only have a 1-year insurance policy. I mean, that's guaranteed at that amount. And that sort of gets people, but I certainly agree with your point that there has to be some way of future casting, of helping people understand what the implications are going to be. Because you take a look at homes, they're going to last for a while. Certainly infrastructure is going to last for a while. And if you're only building that or building it back, in the case of the poor folks who were whacked by Hurricane Ian, based on today's standards, then you're going to leave yourself vulnerable in the future. So anyway, you got into the investment piece, which I wanted to get into, and I think is terribly powerful. As you know, I was part of a project of the Department of Energy a dozen years ago, but even there with the government behind it, we were just distributing $37 billion. And as you say, it's going to take $1 to $2 trillion a year for decades to address this sort of problem. So the pools of money that have to be tapped are vast, which gets me to the last thing I really wanted to cover, which is this idea you were explaining on the new model for insurance. So if you could explain that a little bit, that'd be great.
Okay, let me go into that. In the first, though, let me start with the $1 to $2 trillion number. Oftentimes, people hear the numbers in terms of the dollars that need to be spent to respond to climate change, and think, well, that's impossible, because they're framing it as an expense, that you're just pouring this money down the drain, and then in return for that massive expense, this bad thing, this potential bad thing might not happen in the future. And framed in that way, people say, well, I want no part of it. But that's actually, in my view, completely the wrong way to look at it. The carbon has gotten in the atmosphere from the ways that we meet fundamental human needs for things that everybody needs every day. We all have the lights on in our home, or we need electricity to power our homes, our offices. We need heat. We need to transport ourselves. We need clean water. We need waste to be managed. All of those things are fundamental needs, and they're things that every person, every family, every organization pays for every single day. So by replacing the way that we meet that need today with a sustainable way that we're going to meet that need in the future, there's a cash flow stream there that's immediately available and will go on with great certainty permanently. Effectively, it's a fantastic insurance companies are always looking for long-term, long-duration investments with predictable cash flows. Well, all those things that I talked about, generating power, storing power, heating buildings, getting clean water, they all have very predictable cash flows. So they make a wonderful investment category for insurance companies and pension plans. The key point is, from an outsider's perspective, if you ask somebody, well, how does, say, an insurance company decide to make an investment in the debt of some project that's going to meet some need that people have? I think people think that it's a lot more sophisticated than it actually is. That there's incredibly detailed analysis of risk and return and this scenario and that scenario and so on, when in reality, things tend to be much simpler. It's, well, what rating did that investment get from the rating agencies? And then based on that, what is the required capital that the regulators require the insurance company to hold? That level of required capital is critical. From the perspective of the single insurance company, if they invest in a project and it requires them to hold this much capital in case things don't go well, then that money comes from their investors, and those investors require a return on that capital. So they can just figure out what's the hurdle rate that our investors are demanding in the marketplace, and we've got to provide them with that return on capital. So I mentioned I've been in the industry now for a while. The very first job I had in the insurance industry in 1991 was when the new risk-based capital system was introduced. The work was done in the late 80s and early 90s. It was kind of rolled out in the beginning of the 90s. And that system has existed more or less unchanged for the last 30 years. There have been kind of small tweaks here and there, but it hasn't been fundamentally overhauled. So my key point with this is that the system of required capital that determines what investments get funded and which ones don't get funded is 30 years old. It was created before anyone was really talking about climate change. It gave no consideration whatsoever to climate change. And so the industry has a couple of different paths it can go down, and they aren't mutually exclusive. One would be to work with the regulators, work with the policymakers at the highest level of government, and say, this is a serious problem. Insurance companies and pension plans are investing money based on an outdated system that does not address climate change, and the system needs to be changed. And maybe that will happen. But as you know, changing systems like this that involves changing laws, changing regulations, and then rolling it out to thousands of companies and entities takes time. It's very difficult. All the vested financial interests kick in to argue one way or the other based on their own interests. Another path would be to say, let's just accept it as it is. The system is what it is. If we want to make investments to address the problem of climate change with the existing system, how would we do that? Well, we can actually use a technique that is pretty well worn in the insurance industry and works great, which is securitization, where you say, all right, if I wanted to invest in a single project today, say for offshore wind, and I brought that project to the rating agencies, they would say, well, sorry, we can't give that an investment grade rate because we don't have a long multi-decade statistical data set on the historical cash flow performance of offshore wind projects like this. So, we can give you maybe a single B rating. If you come back in 5 years, maybe we can bump it up for you. And just say, great, we accept that for what it is, but rather than invest in that project as a standalone activity, let's bundle that with, say, a dozen other projects, a big utility scale solar investment, these grid scale batteries that they're the size of cargo containers, and several thousand of those is another project, a new gigafactory to make batteries for electric cars, and a factory to update the way that we manage waste in the US. Make a list of a dozen projects that are all roughly addressing climate change, but aren't exactly the same in terms of how they go about it. Bundle them together, and then create one large package for that financing need, and then divide it into two pieces. The first loss piece would be about 10%, and that's equity, and then the remaining 90% would be debt. Bring that entire package as one offering to the rating agencies, where we'd be much more likely to get that investment grade rating that's so critical, because that's how the whole system is designed to work. So I think that has a lot of potential. And the way that this could work is if you look at the groups that are providing the equity financing for sustainable solutions to meeting people's needs, then that gives you that pipeline of projects. A lot of those venture capital and sustainable equity groups have portfolios that might have 100 different projects in them. And by working with them to say, all right, let's create this new model of getting debt capital into the system, it gives that opportunity to scale things to kind of national scale.
I think that's a fascinating idea. And I think, as you say, people underestimate maybe how much innovation is possible. And I think that the financial system is the way of unleashing that. You may or may not agree with Elon Musk on most anything, but he became the richest man in the world because he attacked a problem that fundamentally will get at climate change. I mean, by making electric cars, even though he had a small percentage of the entire market, he managed to create tremendous wealth. And whether that survives his takeover of Twitter and some of the other things he's doing or not, that still devoted an awful lot of resources to a problem that's key for climate change. And you can see that in all kinds of other ways. I helped a couple of senior McKinsey partners write a book going on 10 years ago now called Resource Revolution that said people talk about this as a problem. And in fact, it's the biggest business opportunity in a century. So if you figure out how to lean into it, then whammo.
Yeah, that's exactly true. And I'd like to just touch on one other thing. I think let's get back to people as they're affected by climate change with respect to the insurance industry. I think there is an underappreciation for how this is already affecting people's lives. So if you take Hurricane Ian as an example, what people tend to look at is say, all right, let's look at structures. Let's look at someone's house. And was the house destroyed by the hurricane? And some houses were, some houses weren't, and say, wow, okay, that's a way to look at the disruption and the damage that it did to people's lives. But what I'm seeing is that it actually goes much further than that. So say, oh, okay, for some people, they had this risk event, their house is now destroyed. For a lot of people, they were underinsured or uninsured, and that's just terrible for them. But look at what happens beyond that. First, there's also a big retirement savings impact. As you know, in America, the largest source of retirement wealth, if you will, is people's homes. And a lot of people plan to tap their home equity through, say, a reverse mortgage or something like that to make sure they can consistently purchase goods and services as they go through retirement. Well, okay, that opportunity is now gone for those people as well. What do they then do? Well, you have no home, your retirement savings was just wiped out. Find family to help you. So you find older people now that they moved out of Florida, say they're living in their daughter's basement in Ohio, and thank goodness they had a daughter. They've got a place to live. But when you look at people who go through that kind of disruption in their lives, older people tend to have a list of health problems, and they spend years kind of establishing a network of healthcare providers and processes, if you will, to manage the chronic conditions that they have. When you shock their lives in that way, you completely disrupt that network of healthcare providers and consistency, if you will, in terms of managing the conditions that they have. And what you tend to see is that they're going to experience a decline in health. You'll never find this in the data, because what they'll do is they'll pop up on some other health hospital systems database 1,000 miles away months later, after their unmanaged conditions blow up on them and create cost for themselves, for society generally. And so there's so many kind of connected risks that are very difficult to actually even identify in the data sets that are out there, but they're very clearly manifesting themselves in the lives of real people today.
Yeah. So I probably ought to wrap this up. I've kept you quite a while. As I think about this, my takeaway is really a sense of optimism. I mean, as you said, there's a lot of innovation that can be unleashed, and if insurers can either reinvent the investment system or lean into the current one, there's an awful lot of capital that can be deployed here. But why don't I give you the last word? How would you summarize the conversation?
I'm in complete agreement. I'm optimistic. Humanity is going to solve the problem of climate change. It's just a question of how much time we're going to take doing it. And I look at it very much like going to the moon in 1969. We decided in the United States of America, we are going to do this, and hundreds of thousands of people worked together. It was amazing. And you can draw a straight line from going to the moon to the US moving beyond just an industrial economy to a technology-driven economy. The same types of effects are going to emerge with respect to climate change. People are galvanized, they're uniting and doing these amazing things to reinvent ways that people meet fundamental human needs every day. There's going to be all kinds of exciting science and technology-driven inventions that come out of that. It will address climate change, and it will also find all kinds of other uses to create economic growth for our society. So I couldn't be more excited about it.
That's great. Thanks for taking the time. It's great chatting as always. I encourage people to check out the other interviews as well in this GIF expert series, and to go back and take a look at some of the sessions, in particular the one that Ken managed. And then beyond that, I'll just say thanks everybody for your time. Thank you, Ken, and hope to see you all soon.
Thank you.